time the stock market is in trouble, everyone starts talking about risk. Do you want to invest risk-free? What does it mean and how to do it? What are the risks of risk-free investing and is it worth it? Maybe you think, well, I have cash, so I'm not risking anything. Cash is great, but it's not risk-free. It means you're losing 6 to 8% every year due to inflation. So if you have 10K, that's 600 to 800 bucks. That sucks. My name is Tommy and in this video we're going to talk about risk-free investments. So what is a risk-free asset? In technical terms, a risk-free asset is an investment with a guaranteed rate of future return and almost no possibility of loss. Because the principal does not decline in value, that's the investment itself, there is no volatility like with stocks or ETFs. Debt obligations issued by the US Department of the Treasury, like bonds, notes, and especially Treasury bills, are considered to be risk-free because people have trust in the US government that backs them. Because they are so safe, the return on risk-free assets is low, but because the interest rates are lower than the inflation, you have to keep in mind you're losing money with investments like these, but it's better than holding cash. Nothing can be 100% guaranteed, and there is no such thing as a risk-free asset. Still, with some investments, the risk is so low that they're considered risk-free. Why would you need a risk-free investment when the stock market is growing? You can just invest in a whole market and get returns. But if the market is 20% down like in 2022, then the question of risk-free investment becomes more relevant. If you have some funds you don't want to keep in stocks, but you don't need as cash, any low-risk investment can be good for you, like a high-yield savings account, bonds, certificates of deposit, and so on. The main goal here is security, so while your rate of return is unlikely to beat inflation, you'll still be able to protect your portfolio to an extent. The goal of a risk-free asset is not high returns, but returns that are higher than the usual savings account rate. Then you have the security. It won't fall during a crisis like a stock or ETF might, and brings you guaranteed results. Because the Fed kept rising interest rates in 2022 and they're higher now, you can get 2 to 3% on a normal savings account and over 4% on a high yield savings account, which is a savings account with a higher yield. Word about bonds. They're a key risk-free asset. A bond is a fixed income asset that represents a loan made by an investor to a borrower. It can be thought of as an IOU that includes the details of the loan and its payments. A bond is referred to as a fixed income instrument since bonds traditionally paid a fixed interest rate or coupon to debt holders. Variable or floating interest rates are also now quite common. Series 1 savings bonds are a conservative, safe investment that rise and fall with inflation, and they're earning far more than the best high-yield savings account or certificate of deposit. The interest rates for Series 1 bonds hit an all-time high of 9.62% in May 2022. They fell again in November, and now the guaranteed rate of return for these bonds is 6.89%. You can cash Series 1 bonds once you have owned them for a minimum of 1 year. However, if you cash them in before 5 years, then you will lose 3 months of interest. So that's a thing to keep in mind when buying them. Bonds are used by companies, cities, states, and governments to finance projects and operations. Owners of bonds are debt holders or creditors to the issuer of the bonds. Buying bonds is a bit different from buying stocks or ETFs. You can buy US government bonds from the government website Treasury Direct. You can buy corporate bonds on the primary market through a brokerage firm, bank, bond trader, or a broker. Government bonds are less risky and bring smaller returns. Corporate bonds are more risky and tend to bring more return. For example, this Coca-Cola bond brings 7.37% a year. Bond prices are inversely correlated with interest rates. When rates go up, bond prices fall and vice versa. Bonds have maturity dates at which point the principal amount or the actual loan must be paid back in full or risk default. A good alternative can be to invest in gold, which is a good option during times of economic uncertainty, rate hikes, and high inflation like we have now. If you want to find out more, watch our recent video about investing in gold to find out how to do it. So in conclusion, there is no such thing as a risk-free asset. One asset that's definitely not risk-free is cash. As I've already said, if you have cash lying around, it's losing up to 10% of its value every year. So if the current rate of inflation carries on, you'll lose the majority of your savings in just a few years. So all investments have different kinds of risks. The challenge for investors is not to try to avoid risks altogether, but to have a balanced approach to risk. Simply ignoring one risk to avoid another risk doesn't mean you're avoiding it. However, when interest rates are rising, existing risk-free investments tend to fall out of favor since their rates are less attractive compared to the overall market. So hopefully this year we'll see another bull market with everything going up all over again, But in any case, looking at low risk and risk-free investments is a good idea for at least a part of your portfolio. So all the best and see you soon.